Okay, guys, welcome back. Apologies for not being able to speak to you on last weekend. I was unwell. I'm hoping I'm back at 100%. So it's good to be connected with all of you now for session number 2, 10th of July. Kind of going to build on what we spoke about in session number 1. So, quick 5 minutes on what we did the last time we met. We spoke about why screening is important. Obviously, the data sets that you might want to get ideas off of can be fairly large. Let's say you're looking at the NSE 200 stocks, and if you want to come up with ideas on a daily basis, if you are kind of manually looking at each of the 200 stocks on an everyday sort of a basis, it just becomes very challenging for you to do this consistently over time, and therefore the need of the hour is for you to access screeners that are already available, or build your own screeners, which is obviously better. Then you can mold those screeners, customize them the way you want, basically accounting for all kinds of market movements. And once you have a screener, click a button, you can choose your universe, you can run the screener conditions on it, and you'll finally end up with a finite list of stocks on which you can basically generate ideas for yourselves or for your clients. So that's really the big pitch in favor of screeners, why we need them. We also spoke about the types of screeners. I said they can be a whole variety of screeners, some based on price, some based on technical indicators, some based on volatility sentiment. I mean, there's really a whole swath of screeners that you can use. And then we said that platforms like Bloomberg and Reuters and Metastock, and now portals like Charting, TradingView, Investing.com, they have ready a list of screeners that you can immediately start using. In fact, TradingView, one of the reasons it's become very popular is because writing a script using Pine script, writing a code using Pine script is relatively simple. You don't really have to go to the deep end to kind of develop basic screeners. The code is simple to understand. So, and you don't even have to pay a certain price. Excuse me. So, this the whole point I'm trying to make with screeners is that the sheer number of screeners available and the sheer number of screens you can create on your own is in itself a very large pool. In the last deck that we shared, I mean, I did give you a list of websites you can immediately start using screening. So please feel free to go over that list again and start, at least building some basic screeners. Give me 1 second, guys. Sorry about that brief interruption. So that was really, an overarching, take on screeners, which we discussed in a lot more detail last time. And then finally, before getting to what is the agenda for today, I want to kind of take you back to the previous session where we introduced Bollinger Bands. I mean, I'm sure most of you have at least heard of it, if not used it. But Bollinger Bands are one of the most commonly used popular tools in the world of technical analysis, along with the RSIs and the MACDs of the world. And then within the Bollinger Bands, after introducing Bollinger Bands for people who hadn't heard of them, we kind of went into a very specific setup called the Bollinger outside-inside, which is going to be the topic of all of the discussions that we have from now on. So, before we dive into what I have for you today, I quickly wanted to revisit the Bollinger outside-inside long setup and the short setup, just so that we have some recency in terms of what the setup looks like. So on the left, I've got the lower band, which is falling. Let's assume that the previous trend has been firmly down. And then I have two back-to-back bars. I've used bars, you could use candles. But really what we are seeing is the outside-inside refers to closing prices. We don't care about the high, we don't care about the low. The open, all we care about is the close on day 1 and the close on day 2 relative to the lower band. So in the long position, you can see This close is outside the lower band on day 1, and the close is above the lower band on day 2. That activates the okay, activate is probably the wrong word. That kind of filters out that setup for you on that particular stock, right? So it tells you, okay, the setup is now in place. Whether or not to trade it is another thing which we will discuss. And then what I've got here on the right is just the upper band. Prior trend is up. Again, I'm looking for a close outside followed by a close inside, but this time I'm making reference to the upper band instead of the lower band, which I'm trying to sell. So again, if you look at the close on day 1, it's outside the upper band. If you look at the close on day 2, it's inside the upper band. So the setup has now been flagged. So this was just the basic setup. I wanted to kind of run you guys over it again, just so that it becomes easier for us to understand what's going to happen in today's session. Great. Now, today's agenda is going to be focused mainly on how do I know when to trade versus when not to trade, even though the setup may be right there in front of me, and also defining position size. We'll talk about risk, we'll talk about reward, and we'll talk about validation of these setups, both the long and the short. So let's start going into how do I decide whether this long setup or this short setup needs to be traded. And the answer to that question comes from this word in box number 3, which is called the trigger. Now, even before I go there, what is the first thing that you will do before you decide whether you need to take a trade or not take? The first thing that you will do is you will define your universe. Just going back to the old world, define the universe that you want to filter. Code this particular strategy. It's very simple. Close outside followed by the close inside. You don't need to know high-ended programming to build this. It's very simple. So identify your universe, punch in the code, let the code run on that universe. It will filter out stocks that meet both the long and the short criteria. So screening for the presence of the setup is very simple. Box 1. So let's say, as of yesterday's close at 4:30, I ran this screener on the NSE 200 on the daily charts. 200 daily charts is what I looked at, or what my screener looked at. And then it tells me, okay, here are 5 stocks on which a long entry has been identified. Now, just because 5 stocks have been filtered out does not mean I will take long positions in all 5 stocks. That depends on the trigger. So the trigger will tell you which trades to take and which ones to avoid. And that trigger, in turn, depends on what happens on bar 3 or candle number 3. So now that the background is in place, let us understand the mechanics of it in row number 2. So first box, row number 2, box number 4, if you want to call it that, is on day 3. What I will look for is, I will see whether the close of 3 is greater than the high of 2. Now, why am I referring to the high of 2? It is because the second candle is the candle that is closed inside the band. For a long entry, it's closed inside the lower band. And for a short entry, it's closed inside the upper band. So if I'm looking for a long entry, I'm interested in the high of 2. If I'm interested in a short entry, I'm interested in the low of 2. Okay, so that really depends on whether you've got a long setup or a short setup. So again, for the sake of avoiding confusion, let us just assume that we are only going to talk about long entries. You just reverse all the rules for a short entry, but let's not confuse ourselves with both aspects of the market at this point. So let's just focus on the long entries. So let us say on a particular stock, I can see that the conditions from the 2 bars or 2 candles is met. Now, whether I end up taking a position depends on what happens on day 3. So let us assume that on day 3, at about 3:25, with 5 minutes to go for the market to close, I realize that let's say a particular stock, it's trading at 85. So current price is 85, 5 minutes to go before the session closes. And then I look at the high of 2 and I realize that the high of 2 is 80. So currently you're at 85 with 5 minutes to go. And the previous high was 80. Now it's obvious that unless something very dramatic happens in the last 5 minutes, it looks as if the close today on day 3 is going to be above the high of day 2, which is 80, because currently you're at 85. So in that case, what I can do is I can take a long position, assuming that with 5 minutes to go, the stock is not going to fall, 5 or 6% lower from where it currently is. So it's obvious to me that the close is definitely going to be, or not definitely, because there are no, nothing called definite in the world of financial markets, but with the stock currently trading at 85, 5 minutes to go, and the high of the previous bar being at 80, I'm 99% sure that we are going to end up closing above the high of 2. So I will take a position anticipating that the trigger condition will be met. Okay, so that is what box 4 is really trying to say. But markets are funny. Something that you don't expect can happen. So let us say 5 minutes to go, the market is at 85. Previous high was 80, and you are 99% confident that the close of day 3 is going to be about the high of 2, but you are 1% unsure, right? And let's say that 1% scenario pans out. So suddenly something happens. Maybe the company spokesperson makes a statement which is not so good, and the stock in the next 2 minutes drops from 85 to 78. Right. So in that case, given the size of the drop in very quick time, you will probably go with the assumption that, okay, something's really gone wrong, and it looks unlikely that the close today is going to end above the high of 2, in which case you don't trade. You don't go long. Now, for people who first discovered this particular setup, they said, honestly speaking, a long position can be taken on any day, assuming the close of that day ends above the high of 2. Remember, the high of 2 is fixed. So let us say day 3, there is no long signal. Day 4, there is no long signal. Day 5, day 6, day 7, day 8, day 9, no long signals at all. Because on none of those days, the close has ended above the high of 2. But let's say on day 10, there is a close that is going to be comfortably above the high of 2. So the more flexible traders / investors will go long. But my personal preference is I will either trade long on day 3 or day 4 maximum. If by day 4, my trigger condition is not met, this is a personal preference based on experience. If by day 4, my long position is not triggered, it doesn't matter what happens on day 5 or 6 or 7, 8, 9, 10, I will not trade. But that is my personal preference. So now when we look at the next slide, whatever I've said here, particularly in row 2, will become very clear. Okay, so stay with me. So I've got 2 scenarios. They're very different scenarios, but they're both pointing to long positions. So let us look at the first scenario. This is the ideal scenario. So previous trend is down, lower band is collapsing. Nobody thinks the market can bottom. Ideal, situation, ideal backdrop for the market to actually bottom. But I need some conditions, and I need a follow-through trigger. So the conditions are what you see in 1 and 2. I can see that the close is below the lower band. I can see the next close is above the lower band. So the condition is met, but I need a trigger. Now let us look at bar number 3. Let's say this is day 3. So it's a wide range bar. I can see the high-low range is the widest in this entire pattern, which basically means a lot of people are, a lot of churn happening, a lot of activity, a lot of participants are buying and selling the stock for reasons best known to them. And what I see, just maybe 5 minutes before the close, I see that the close is comfortably above the blue line. Where is the blue line in the context of what's happening here? The blue line is drawn from the high of 2. So the further the current close is from the blue line, the more convinced I am that yes, I'm going to end up going long on day 3. So this is the perfect signal that I will look for. I personally will look for. Now, if this were to occur on my chart, I will definitely go long. Now let's look at a variant of that. So again, the setup bars are bars 1 and 2, close outside followed by close inside. That's pretty good. On day 3, you can see that the market broke through the high of day 2, but it closed below it, so no trade. On day 4, again you broke above the high of 2, but you closed below it, no trade. Day 5 is interesting because the high-low range is contained within the high-low range of day 4. It's called an inside bar. An inside bar represents volatility shrinkage. And one of the things we know about volatility is that volatility is cyclical. Low volatility situations can, morph into high volatility in the future, and high volatility can morph into low volatility in the future. That's one of the most amazing aspects of volatility, alongside mean reversion. We're not going to go into the quantitative aspects of that. So just to say that this was a more volatile day, the wide range bar, and this was a less volatile day when compared to this day. So look at what happened on day 6. Day 6, you not only close, you not only break the high of 2, but you also close above it. So this is still a valid signal for most people. They will go long here, but I won't. Why? Because as of the close of day 4, I did not have a long entry. So I'm not going to go long, but if you are one of those traditional old school guys, you will still think this is a long signal. Now, one of the things I want to very quickly mention here, which is not on the slide, is that regardless of how you go long, whether you go long on day 3 or day 4 or day 10, your stop loss is always going to be the lowest of the 2 setup bars. So if I go long here, my stop loss is going to be 1 tick below the low of 1. If I go long here, I'm going to ignore 3, 4, 5. I'm going to ignore the low of 6 as well. That doesn't matter. But if I go long here, because the close above the high of 2, my stop loss is going to be 1 tick below the low of 1. Simple. Again, it's a valid trigger, but I will not trade anything beyond a signal that gets me long beyond day 4. Okay, so that's just my preference. Now, I've already spoken about this, but here is a visual. I will definitely take the signal. I will also take this signal. Now, what's different here? So 1 and 2 are, what we've spoken enough about. Day 3 is an inside bar, because the high-low range of day 3 is contained within the high-low range of day 2. Now, when an inside bar occurs, and this is my preference again, let me repeat. When an inside bar occurs, because the high-low range is contained within the range of the previous bar, I'm going to think that bar 3 does not even exist. I'm going to completely ignore this. So for me, technically for this setup, the next bar, which is actually bar 4, is going to be bar 3. So I'm going to ask myself, is the close on day 4 for other people and on day 3 for me, because I ignored this, is the close here above the high of 2? So for me, this particular bar does not even exist. I'm only counting 1, 2, and 3. So technically, the close on 3 for me is above the high of 2. I'm going to go long. But this is only up to bar 4. Beyond bar 4, I am not going to be interested in going long. It doesn't matter even if the stock rallies 100% and me not having a long position. That's okay. The market's open 5 days a week, 250 days a year. Not accounting for holidays, there will be many more opportunities. There are different time frames. I can always find a better opportunity, but I'm not going to go against my predefined rules. That's very, very important, and probably the toughest aspect of trading to master. Okay, regardless of how good your system is. So I remember we kind of introduced the chart, this particular chart, the first time we met, but now why certain setups are labeled yes and why certain other setups are labeled no will become very clear. So if you look at the signal at the bottom left, there is a plunge. It's a 4-day, it's a vertical plunge. Two very wide range bars, the first one and the fourth one. So let's look at the fourth red candle here. Close clearly outside the lower band. The next close is inside the lower band. And on the very next day, I can see that the close is above the high of day 2. So I'm going to go long. You caught the bottom. These are short signals. You just reverse the rules, right? Like I said, and you know why these short signals should not have been taken. It's a good idea because the market kept rallying for a few more days. I would have definitely taken this long signal. Why? It's a long range candle, a lot of selling pressure. If you look at this candle, so firstly it's closed below the red candle is closed below the lower band. Next candle is closed above the lower band, and I can see that the real body of the next candle is very small compared to the real body of the previous red candle. That itself means that this candle was a selling climax. Everyone who wanted to sell has already sold. Now, if already the bulk of the selling has taken place, I want to know whether bulls are now starting to get interested. How will I know that? Look at what's happened on candle 2. This is a hammer because the lower shadow is at least 2 times the size of the real body. So there is a hammer. It's closed above the lower band. And on the very next day, I have a close above the high of the hammer. This is a perfect situation for you to go long. And you can see you had a very nice run up in the next few days. I would have ignored the first sell signal here. I would have taken the next sell signal here. I would have ignored the next sell signal here for reasons that should be known to you now. This is tricky. I said depends. And why is that? That is because of what I showed you here. This is a long signal. I'll kind of reverse this and talk to you about that short signal, which I would not have taken, but other traders might have taken, right? So let's go into that and understand the backdrop to this. So I've got this blue candle which is closed above the upper band. I've got the next red candle which is closed below the upper band. So the setup is complete. And then the first thing that I should immediately do is I should draw a horizontal line through the low of the candle that's closed inside the upper band. So you can see where the yellow line is. And for the next few days, the market just goes chop, 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 no net direction. I don't have a single close below the yellow line until I reach this point. So this is a close below the yellow line. Old school traders will probably sell this with a stop above the high of the blue candle, the first candle in the setup, but I will not trade it because it's gone beyond day 4. And now that you understand, the yes and the no's on the way up, yes and the no's on the way down are using exactly the same logic, so we don't have to spend time on this. Now let us talk about position sizing. Very, very important. So I've used 3 approaches, and these 3 approaches is what you will typically find people talk about from a position sizing perspective. So the first one is equal value. Very, very simple. Let's say you have a total capital of 50,000 available to you. Now, whether you trade 20 stocks, 200 stocks, or 2 stocks, you only have 50,000 rupees given to you by your mom and dad. Okay, so your total capital is 50K. On a particular day, I get 2 signals, and both signals are a buy signal, right? 2 is just some number. So let's say I ran my screener and 2 stocks stood up from a long entry perspective. So 50K available capital, 2 stocks have popped out. Now the total value that I will therefore invest under the equal value methodology is just the total capital available divided by the number of stocks that I want to buy, which is 2. So I invest 25,000 in each stock. And how many units of each stock will I buy? That really is a function of 25,000 divided by the price of the stock. Simple. Okay. So that's the equal value approach recommended for absolute beginners. Now let's move on, get a little more complicated and smart with the equal risk approach. So again, the total capital remains the same as before. It's 50K. But now I will immediately define my initial risk that I want to commit to each position. So let's say the initial risk that I have I'm comfortable taking is about 10% of the total capital, which in this case is 10% of 50,000, which is 5K. However, in the markets, if you're a beginner trader or investor, it is recommended that you do not go beyond 3%. Some people vouch for 2%, but 3% is a good number in technical analysis. Some people say if you're a beginner, do not risk more than 3% on any one position. You can. It really depends on you and how experienced you are in the world of trading. So, for the sake of simplicity and easy mathematics, I have chosen a nice round number, 10% of 50K, so 5,000, and my position size is therefore going to be that initial risk per trade, which is IRT, the numerator, divided by the difference between my entry price and my stop loss. So E is entry price, SL is stop loss. The difference between the entry and the stop loss goes into the denominator. The initial risk per trade goes into the numerator, and that's how my position size is determined. Approach number 3. I will define my position size, which now will be a function of volatility, which will be captured by something called the average true range, or ATR. So my total capital is 50,000. My initial risk per trade is, let's say 5%. I've chosen a different number for the sake of variety. And my 14-period ATR is 20%. Now, what is ATR? We will discuss this more in more detail in subsequent sessions. But just to tell you, the average true range is the best measure of the underlying volatility of a certain instrument, which also accounts for post-session gaps. So between the time that the market ends for a particular day and the open on the following session, the stock can jump up or down depending on what happened between the close on the previous day and the open of the next session. Basically, some statement that came out post markets, or some economic data that you think was really poor and will affect the business of this particular entity. So there are a lot of things that can happen while the markets are not trading, and the ATR also takes into account such situations in its computation. It accounts for those gaps. So generally, when people speak of the ATR, the average true range, the period used is 14, as is the case with the RSI. You can really use anything you want. The higher the period, the lower the volatility. The lower the period, the higher the volatility, right? So I would expect, a stock to be, 20% volatile over the next 2 days. But it's very difficult for me to think that, or okay, let me give you a better number to understand this. I would probably expect the stock to, to have a 1-day volatility of 5%, depending on what's happened historically. But I would definitely not expect the stock to have a volatility of 5% over a 100-day period. Okay, if it's 1-day volatility is 5%. So the lower the volatility, the higher the lower the value of the ATR, excuse me, the higher the volatility is going to be. Nonetheless, like I said, right, we will discuss this in more detail when we jump into, I think, sessions 3 and 4, session 2. Right? So again, let's come back to what I'm really trying to do with the ATR. I'm trying to compute my position size, which in this case, again, so the IRT remains the same as before, goes into the numerator. But the denominator is now my 14-day ATR multiplied by a user-defined threshold or factor, which I've called X. Experienced people who have built tons and tons of indicators and position sizing algorithms using ATR recommend that X needs to be anything between 1.8 and 3, but it really is a function of how you trade, either driven by your own, risk reward metrics or driven by the policy that governs the firm that you belong to, right, by mandate. Now we've got quite a few things on this slide, so I want to simplify this down. Just by telling you that although there were formulas, at least with respect to equal risk and the volatility-driven methodologies, the formulas can be, better interpreted, better understood by understanding what happens when we move the components of those formulae. So before we go into equal risk and volatility, to kind of understand the formulae better in a more, easy to comprehend sort of structure, let us understand equal value. So it's very obvious that if you reduce the number of stocks that you want to hold in your portfolio, then the position held in each stock will go up automatically, right? If I have a 50,000 worth of capital and I want to trade 10 stocks, then the value I'm going to, the amount I'm going to invest in each of those 10 trades is going to be 5,000. Now on day 2, if I get only 2 signals, and so let's say I have another 50,000 of capital, but I get only 2 signals, then I'm going to invest 25,000 in each stock. So the amount that I invest in each of those 2 stocks will obviously be higher, 25,000 as opposed to 5,000 before. So that's very, very simple. Now let's come to equal risk. So, if I just go back to the previous slide, just mind map the formula here. It's IRT divided by the difference between the entry and stop loss. If you just keep that in your mind for the next 1 minute, it's obvious that if you increase the numerator, which means you increase your initial risk, or if you are entering at a lower price, which means your E is lower, or if you are defining a larger stop loss for that particular security, your position size will increase. Okay, that comes, and vice versa for short. If I go back to the formula, let us assume that this is lower. Okay, so IRT is lower. This is higher, and this is lower. So what happens is the numerator is now lower as opposed to before, and this is now higher as opposed to before. So you have a lower numerator divided by a larger denominator. What will happen? Your position size will fall. On the other hand, if this is higher, or if this is a lower, or if this is higher, then your position size will automatically increase. So your position size is defined in this case by what each of these 3 components does. And if you move any of these variables, keeping the others constant, this number will also change. That's obvious. So it's not so much about the form. Don't get bogged down by the formula. Just understand the intuition in terms of what happens if I move one of these 3 variables, keeping the other 2 constant. Okay, you can choose to move anyone. Same thing happens with the volatility-based methodology as well, right? If this goes down, but this product goes up, your position size will be lower. If this goes up and this goes down, your position size will be greater. Okay, same thing. which is what I've kind of specified here. So take a look at this when you can. Now we've spoken about enough. Rather, we've spoken enough about how to define my position size, how to define my initial risk, you know, how to use the ATR. Like I said, particularly with respect to the ATR, we will use this in much more detail in the future. For now, it's just enough for you to understand that ATR is a very, very popular volatility metric that is used in a lot of algorithmic trading systems. So that's great. We've defined risk, based on our individual trading metrics and so on and so forth. But the most important thing is where to exit. Now, the exit can be driven by one of two things. Either the market has triggered your stop, so you are forced out of your trade, or you had a happier exit, which means the market got to your target, and that target can be decided by any means. But I will discuss a few things. So exits can happen either in a stop loss scenario or a take profit scenario. So let's talk about row one, which delves into stop losses. So a user-defined stop loss, which defines your initial risk level, is an absolute must. One must not average down. What does that mean? I bought a stock. I bought 100 units of a stock at 50, so my initial capital was 5,000. 5,000 is what I invested in that particular stock. And so I bought 50 units. Entry price was 100. I had a take profit target in mind, which is 20%. So let's say 120 is my objective, and my stop loss is, let's say, 95, 5%. Right? So entry price is 100, stop loss is 95, take profit is 120. So I got the signal, everything is good. My long trade is in effect. And then what happens is, post the close of a particular session, the company makes a statement which is not so bullish, and the market then drops to 90 at the open on the very next day. So remember, the original plan was bought at 100, stop loss 95, take profit 120. And let's say this was a mental stop loss. You did not keep the take profit or the stop loss in the system. It was just a mental stop loss that you wanted to work with initially. And then you wanted to see whether the market, moves in your direction or whether it starts moving towards 95. So it was more of a, mental thingy that you did. Company statement comes out. Markets are closed, can't do much. Next open is 90, next morning. Now, this is where psychology comes into play, and it's often the toughest aspect of trading success, achieving trading success, better put. Now, what will happen is, it's opened at 90, but you tell yourself, look, this was just, a statement that caused this sort of a reaction. I'm still very hopeful on the prospects of the firm. I don't think fundamentally anything has changed. Although price is 10% lower at the open, you still don't think nothing is, anything has changed. So you say it's come to 90, no, let me buy another 50. That's called average down. Never do it. In equities and with blue chips, you might still, and with liquid enough securities, you can still get away with averaging. But in the world of currencies, commodities, rates, never do it, because that will ensure that your trading life is very short-lived. Never average down. So if there is a stop loss and the market has blown through your stop loss, take that loss and get out before it becomes bigger. I'm sure you've experienced this, like any of us has, including me. Now, for a long entry, I've already said this. Specific to the Bollinger outside inside, if you go long, the stop loss is the lower of the two lows, and if you go short, the stop loss is the higher of the two highs. Now, even although your stop loss may have been punched into the system, you may still end up making a far greater loss than the loss that you were originally willing to take because of a gap up or a gap down. So exactly the situation that I spoke to you about. Long at 100, objective 120, stop loss 95, but the market opened itself at 85. So if you take that loss, how much have you lost? 15%. But what were you prepared to lose in the first instance? Only 5%. But that is the nature of the markets. Which is why, at least, in the markets of today, most people, particularly when they are using leverage via derivatives, they will never, go naked long or short futures, because a gap can really kill you. And if your position is large enough, plus is leveraged, which is like, gunpowder next to a matchbox, things can get really ugly really fast. So everything depends on the position size. Okay, I can't stress enough on the importance of position size. So that was row one, where we've spoken enough about stop losses and the challenges with markets basically surprising even the most robust systems. And now we'll talk about take profits. Take profits, the first of which is very simple. I'm just going to say my target is a fixed percentage of my entry price. So coming back to my original example, entry is at 100, target is 20% above 100. So at 120, I'll exit the entire position. That's a fixed percentage, take profit objective. As you get better and better at this, you start learning more and more. And this is something that I prefer. I use a lot of Fibonacci ratio. So I can say, okay, once I've gone long or short, I'm going to do a Fibonacci retracement to the previous trend. And, there are certain Fibonacci numbers that the market typically respects a lot. So when it comes close to when the market moves in my intended direction and gets me to that very important Fibonacci number that I'm tracking closely, that is where I will exit all of my longs or shorts, or at least take a sizable position of my existing open position, out of the trade. So that's really up to you. Some people who are more old school, who believe in historical support and resistance, someone like me, I believe a lot in what the market has done in the past. The market always rhymes in the future. It kind of remembers where it initially struggled or historically struggled to get past. So either support or resistance. So it knows, it has a liking for what's happened in the past. It memorizes where it might have struggled in the past. So I'm very old school. I think I'm a blend. I'm more old school plus a bit of quants thrown in, but still, I very much believe in conventional technical analysis and all of the stuff that used to happen like 30, 40 years ago. It's still very relevant because human psychology doesn't change, right? So fear and greed, those aspects and how you react to those aspects, that hasn't changed in the last 200 years and will not change in the next 200 years. So conventional technical analysis will always have its place in the sun. Historical support resistance, always very important. Trend lines, always going to be very important. So I will, one other approach that I typically look at is if the market, has clearly exhibited to me that there is a certain area of support or resistance that it's kind of adhered to in the past, then I'm going to use that to book my profits if the market goes in my favor. We're talking about Bollinger bands. So, another approach to taking profits can be based on the bands themselves. So you can say, if the market reaches the middle, let's say you're long, okay, you've got the perfect entry, you're long and the market started moving higher, which makes you really happy. You might say, if the market gets to the middle band, I will exit 50% of my position. That really depends on you. And if the market then rallies even more, and let's say you believe that the momentum in the market is so high, volumes are growing, everything is in favor of bulls. If you think the market is going to rally higher, then you might say, okay, I'm going to keep the other 50% position open, which I will actually exit when the market touches the upper band. So it's completely up to you. But and these are not the only three take profit mechanisms that you can use. You can use another 20 if you wanted to. These are some things that I closely follow. So that's about it for today. We are happy to do some Q&A now, if anyone has any questions.
Guys, you can post your questions into the questions box or the chat tab. Again, just to repeat, there are two panels on your right-hand side, which will say questions or it will say chat. You can post it in either one.
Cool, Kezad. I don't think we have any questions.
I was just going to say that I don't think we have any questions. So I think we'll go ahead and end the session.
Thank you very much, guys, for your time. I'll meet you next weekend. Thank you.
Thank you, Akshay. Thank you, everyone.
Bye.